TSMC is 50% down year to date, and they just reported their 2022 Q3 earnings. So let's take a look at them and analyze the company. So, for those that do not know, TSMC stands for Taiwan Semiconductor Manufacturing. The company was founded in 1987 and has been the world's largest dedicated semiconductor foundry ever since. They are the first foundry to provide 5-nanometer production capabilities, the most advanced semiconductor process technology available in the world. The company is headquartered in Taiwan, which for political reasons may be very important. So, let's take a look at the recent results. Cash and cash equivalents are up by 51.8% year over year. So this is really nice. But also the total liabilities are up by 50.8%. Now, year over year, third quarter revenue increased 47.9%, while net income increased an incredible 79.6%, with an earnings per share increase of 79.8%. And even though they beat the analyst expectations, their shares started the day with an over 2% drop. So why is that? Well, because in the results they warned of weakening demand in the coming months. One example of that may be the news that their largest customer, which is Apple, has reversed plans to boost iPhone 14 production later this year. And geopolitical tensions present another potential headwind for this company. Wendell Huang, Vice President and Chief Financial Officer in TSMC, said, "Our third quarter business was supported by strong demand for our industry-leading 5-nanometer technologies. Moving into fourth quarter 2022, we expect our business to be flattish." So they are anticipating a slowdown in their business. But these are all short-term news. So let's take a look at the big picture. First, let's see who invests in TSMC. Insider ownership, that is an X. It is 0.4% for individual insiders. And insider buying, that is also an X. Insiders are not buying in recent months. What about super investors? That is a check. There are 10 super investors that own the shares of TSMC. And are they buying right now? Yes, they bought over 5.5 million shares in the second quarter and sold just over 100,000 shares. So now let's take a look at the financial health of this company. Return on invested capital. That is a check, and it is 21.6%. And we are looking for a number over 10%, so this shows us that the management is doing a really nice job. And what about free cash flow growth? That is also a check. It is 24.1%, so a very nice and healthy growth. Now let's take a look at the profit margin. That is also a check. It is a 45.8% margin, and the average for the market is 31.6%. So they have a strong pricing power, probably due to being the only producer with 5-nanometer production capabilities. And shares buyback, that is an X. They made no changes in the amount of shares they have in the last 10 years, which probably can be viewed as a good thing. We know we are not getting diluted, and it is also easier to forecast the future if the company is not making any sudden moves. And what about the debt? That is also a check. It would take them just over 1.5 years to pay back their long-term debt with their trailing 12 months free cash flow. And before we find the intrinsic value of this company, let's take a look at the dividends. The dividend yield, that's a check. They have a dividend yield of 2.3% and a payout ratio of 38%. So that is also a check, because we are looking for a payout ratio between 30 and 50%. So this is very nice. We know we are getting a decent part of their earnings, but at the same time, it is not that big that it could threaten the financial stability of a company. And is the dividend growing? Yes, that is a check. It grew about 10.1% in the last 5 years. Okay, so we know some fundamentals about TSMC, and now let's value it with a discounted cash flow formula. And for this valuation, we will use a trailing 12 months free cash flow so that we can see how the recent results influenced the valuation. And we will have to estimate the growth of the company for the next 5 years and then another 5 years. And we will make 3 scenarios, a low, a medium, and a high one. In the low scenario, we can estimate a growth of 8% in the first 5 years and then 10% in the next 5 years. In the medium scenario, 12% and then 10%. And for the high scenario, 15% for the entire 10 years. So around the same growth the company had for the past few years. So the intrinsic value per share is $59 in the low scenario, $70 in the medium, and $94 in the high one. But of course, these are not the prices we should be buying this company for, because we have to always add a margin of safety. In my case, I use a 30% margin of safety, so that even if my estimates are wrong, I still have a chance of making this investment work. So, with the margin of safety, we should be looking for a price of $41 in the low scenario, $49 in the medium, and $66 in the high one. And the current price is $62.50. So, is it a good investment opportunity? Well, it really depends on which story you believe in. The company is in a good financial health, they have a strong and stable dividend, but at the same time, they are facing a number of problems. And that can influence investors, especially the short-term investors. The main problems are smaller demand for microprocessors and political tension between China and Taiwan. But that is only my way of looking at this company, so remember to always do your own due diligence before making any financial decisions. So that's about it for today. Please like this video if you enjoyed it and subscribe to the channel if you haven't already. Thanks for watching and see you in the next one. Bye bye!